Hello, friends. Welcome to the monthly edition of Fixed Income Outlook for the month of July. We have Kaustubh Gupta who has joined us for the session. Welcome, Kaustubh.
Hello, Naya.
Uh, Kaustubh, after the strong Modi mandate coming in, last 10 days, a big event in terms of union budget.
Yes.
Your key takeaways on the union budget that you want to share.
So this budget was presented in the backdrop of strong mandate to the government and faltering growth, which is the case since September of last year. In this backdrop, some section of the market were fearful that government will use some counter-cyclical measures by expanding fiscal deficit to propel both consumption and investments. Good to give credit to the government, they stick to the path of fiscal prudence and macro stability, and they targeted revised fiscal deficit target is at 3.3% of GDP. Having said that, we do see some small amount of slippage could happen on this revenue front, but we think they are still manageable and achievable by and large. To sum up, government has clearly taken measures to reduce the cost of capital by taking two steps. First, they have reduced the overall target of PSU borrowings and IEBR supports from 3.25% to about 2.5% of GDP. And second, they have also promised that some portion of their government borrowing program will be borrowed by issuing a sovereign bond in offshore countries. We think that both steps will help in crowding in the private investment by reduction in cost of capital. Budget also announced a significant measure for NBFC by allocating about 1 lakh crore as a first loss credit enhancement facility for the pools to be bought by PSU banks. We think this is the first significant steps which has been taken by the policymaker for the recognition and addressing the NBFC crisis in hands. Thus, budget reinforces the signal which came from the economic survey that policymakers are not taking the shortcuts by boosting consumptions at the risk of macroeconomic stability. The idea of this government is to boost capex, largely private capex, reduction in cost of borrowing, and take medium to long term paths for the stable economic growth in the country.
Kaustubh, that was a good brief covering union budget. Just as a follow-up question, what's the view on the fixed income markets?
Given that the government has strict to fiscal deficit targets, international crude prices which remain quite benign, both global and local growth which are struggling at the lower end of the curve or desired level of policymakers, and global slowdown which is continuing and paving way for benign global rate cycles, we expect that RBI will take all these factors into account and they will ease monetary policy further in the next monetary policy committee. Thus, we remain constructive on fixed income for now.
Kaustubh, with that backdrop, current portfolio stance that you hold on and advice in terms of investors should look forward in terms of investing into opportunities.
So clearly, policymakers as of now they are focusing on reducing the cost of capital and monetary policy transmission for the rate cuts which have happened in the past, and thus there is a strong case to remain constructive on fixed income, especially on the shorter end of the curve, because as the monetary policy transmission takes place, the shorter end of the curve, which still remains quite elevated over the repo rate, it provides reasonable opportunity for investors to invest. Thus, we would advise investors with a low risk appetite to move to the ultra short term funds, money market funds and low duration funds, and investors with short to medium term horizon or little bit of risk appetite to move to Aditya Birla Sun Life corporate bond funds and banking and PSU funds. As the monetary transmission will take place, these corporate bond spreads in 1 to 3 year space, not only they will compensate investors for the potential capital gains, but even from the accrual perspective, they provide reasonable opportunities for the investors. For retail investors, of course, the credit risk funds from a medium to long term horizon, they still make quite a reasonable sense for them to continue to invest from 3 year perspective.
Well, Kaustubh, that was quite insightful. Thank you for your time for joining us in this session. Thank you, viewers, and please keep watching more for more insights coming ahead.
Thank you, investors. Thank you, Nayan.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.